All right, so we are now joined by Seth Ackerman, Jacobin's executive editor. Seth, good to see you.
Good to see you too, Jen, as always.
So, we're here to talk about inflation and the Fed. I should mention you have a series of pieces in Jacobin and also on your Substack newsletter that I think kind of go against the received wisdom on inflation. And one of your recent points was that nobody really ever stops to ask why inflation is bad. So, I'll go ahead and take the bait. Why is inflation bad? And maybe specifically, I feel like the underlying assumption is when you have inflation, prices go up. And, if people's wages are not also going up, or if they don't rise as quickly, then obviously it costs more to buy goods and services. And that seems bad. So what does that miss, or what does that leave out?
Yeah, there's a kind of an obvious basic logic that nobody likes higher prices. Higher prices aren't good for anybody who's paying the higher prices. And when there's inflation, obviously that means that there's higher prices. People notice that, people see that, and they feel it. And so in that sense, inflation is not popular. But at the same time, the other side of the coin, which this is not a secret, but it's something that people often forget, is that for every buyer, there's a seller. For every seller, there's a buyer. So when you pay money higher priced for goods and services, somebody is that's going to somebody's pocket. And in the end, inflation can't really sustain itself over time unless people's incomes, their nominal incomes anyway, are rising sufficiently fast to allow them to buy all that stuff. The prices can only rise if people are actually able to buy the stuff. So in the end, the last thing I would say is that inflation can never be a bad thing, can never be a net negative economically, but ultimately it's a lot more complicated than just the issue of prices going up. So I think probably the most basic question that has to be asked whenever there's inflation is the distinction between supply and demand. So, the price of something can go up because people are more eager to buy it, and so they're willing to pay more money. Or the price can go up because people are more reluctant to sell it, and so they have to be induced to get a higher price for it. And so there can be, demand-based inflation with too much demand. There can be a supply-based inflation based on what they call a negative supply shock, where suddenly people are less able or willing to sell the things that you need to produce goods and services, or the goods and services themselves. And a big part of the debate that's been happening since this surge of inflation began, a little over a year ago among economists, was this question of, is this about supply or demand? Is this about a demand shock or a supply shock? Now, keep in mind, there's always a political angle to these debates. So, inflation has risen pretty much around the world, not necessarily as much as in the United States everywhere, but everywhere there has been an increase in inflation since COVID, since the recovery from COVID. But in the United States, there's been a political edge, an ideological edge to the debate, the economics debate over inflation, I think because, in large part because of the stimulus, because of Joe Biden's stimulus. So the stimulus itself, at the time was not enormously controversial, if you remember. I mean, it's not like the Republicans were making it into a big issue. They themselves had passed stimulus bills under Trump. Trump had signed these bills that, sent out free money to millions of people. It was not a major political issue. The Republicans didn't vote for Biden's stimulus in early 2021, but they didn't make a big political issue of it. But among economists, among the people who, get into this kind of stuff, and that includes the people around the Fed and the kinds of debates that they take part in, there was an ideological edge. A lot of it was introduced by one person, which was Larry Summers, who clearly, he went on a kind of a crusade about it. He had been sort of ejected from Democratic Party politics after the primaries, when his name had come up as a possible advisor to Joe Biden, and there were protests from progressives, and he basically ended up saying, I'm not going to work in government anymore. And so his mission, I think at that point his mission in life became to denounce the woke takeover of his corner of the Democratic Party, which is the economics side of things. So that's become his thing. And so for more than a year, he was banging the drum about how he was basically injecting an ideological angle to this debate that doesn't really exist in other countries that are also experiencing inflation. So for him, this was because of too much stimulus, too much demand. And that's the cause of the inflation. And the Fed isn't helping because the Fed has gone woke. this is what Summers has been saying. And so as a result, the Fed has been behind the curve. They failed to tighten monetary policy enough in time to nip the inflation in the bud. So that's one side of the debate, which is where people with Summers' point of view want to emphasize the inflation as being caused by too much demand, because that's what the stimulus was, too much demand. Well, the other side of the issue is supply. So, I mean, there's a kind of it's very easy to listen to these debates, people like Larry Summers, and forget that we're having a global pandemic that has been one of the most massive supply shocks in peacetime in world history. Literally, 500 million people have been infected with the disease that made it hard for them or impossible for them to work. There were rolling shutdowns of ports and factories and every kind of productive facility all over the world. And there were many months where there was almost no economic activity going on at all. So this was a huge supply shock. So that is something that if you had told, an economist 10 years ago, you'd come back from the future and said, there's going to be this pandemic and it's going to cause all these shutdowns and millions of people are going to be infected. And probably the economist, if he knows what he's talking about, he or she was talking about, they would say, that sounds like it's going to be inflationary.
Right.
So that would that's to be expected that there would be inflation. So the question is, this makes a big difference about what you think about the impact on working people, right, what you think about the correct policy response. Because if it's too much demand, then in some sense that's an easier problem. Then you can say, well, there's too much spending, people are spending too much money. You just need to implement policies that reduce the amount people are spending, and then that'll solve the problem. But if the problem is a supply shock, if the problem is that these events have taken place that have made it more difficult for people to work, to supply their labor, to sell the things that they own or the things that they can supply, then there's not a very good solution to that other than the actual solution to that, which is, getting past the pandemic and finding ways to get people back in the labor market or whatever. And that's a hard slog. That's something that the Federal Reserve only have the tools to control demand. Right. They can deal with interest rates. They can make it more costly to borrow and reduce spending that way, but they can't do anything about, how many people get infected with COVID. Right. So that's where the crux of the problem lies. And from the point of view, I'll let you get to your next question, but that's the basic economics aspect of it.
Well, I want to kind of stay on this sort of supply side for a second, because when you look at all of the national polling around, what people are feeling or what they're thinking about inflation and who they think is responsible for it, people basically overwhelmingly say, in so many words, the supply side, right? Like they talk about the supply chain breakdown, they talk about the pandemic. They also increasingly talk about corporations, right? They say, we think that a lot, I think according to one poll, a super majority of people said something like, we think that corporations are basically colluding to raise prices. And I think that this kind of narrative that corporations have a heavy hand in inflation, I think has sort of taken off in response to what you were talking about, the kind of Larry Summers, woke Fed, sort of this is a demand issue narrative, right? This idea that the corporations are actually doing something is something that, people on the left and progressives are now trying to look at. And it seems like a lot of the public feels the same way. So maybe as just a broad question for you, how much does corporate greed explain sort of current price hikes?
Well, first of all, I completely agree with the point that you made. It's a really good point, and I haven't seen it emphasized enough, which is that the public perceive they're not plugged into these debates among economists. When they perceive inflation, which they do, obviously they see prices going up. The things that that are visible to them, that are most visible to them, are the supply issues. The demand issues about the stimulus. Everyone got a big check, and people that's something that all else equal is going to be inflationary. But people don't think very much about that, if only because like I said, it hasn't been much of a political issue.
Yeah.
So in a sense, I think this is frustrating for people like Larry Summers, is that when the public sees inflation, what they think of is they think of COVID, obviously. That's the first thing, we've had this giant disaster and that's why we're experiencing inflation. The supply chain issues, people know that the shelves are empty in some places or it's hard to get certain goods. That's unusual. And it's clear that there's some sort of a supply. So yes, I agree with you that is how the public perceives things. And then on that point, there is this critique on the left that says that there's an issue of sort of basically kind of an antitrust issue or a monopoly issue among corporations. And Larry Summers and people like him have been very critical of this. They say that this is silly because, among other things, I think that the probably their best point is that in terms of just, even if you were to accept the idea that antitrust monopoly type issues are a major feeding into the inflation problem in a serious way, from a policy perspective, there's not really much you can do within the space of time necessary in using traditional antitrust, blocking mergers or breaking up companies that's going to actually solve the problem. Then there's the question of price controls, which opens up a whole other can of worms, because there was a big debate, a rather acrimonious debate about that recently on Twitter. We can talk about that too. To answer your question about corporations, I think that there is, just in terms of like describing the source of the problem, I do think that there's probably some aspect of that, but there's almost certainly some aspect of that is the case. I saw, for example, that there was an article in the Financial Times about the automakers, and the automakers, have had this very difficult problem with that's very much a supply issue. But they can't get computer chips, they can't get semiconductors, and this has been blocking their production of cars. And there was basically both of the two main competitors in one of the segments of the car industry. I forget what it was, Volkswagen and something else. There was talk from some of their executives anonymously that we're gonna raise prices. For a long time we've been hesitant to raise prices because it would alienate consumers. But now we feel like there's a kind of a taboo that's broken or something like that. There's people accept it now because there's a feeling like we're not in normal times. And so, they're able to do this. And I think that is a real phenomenon. And it's something that you can explain in economics terms, because a lot of the pricing in these big, oligopoly markets is really indeterminate. It just depends on what the two companies can sort of tacitly coordinate on. So there is definitely some element of price gouging here. And then there's probably the deeper problem when it comes to sort of the corporate greed aspect of things, which is that in order to solve these supply problems, ultimately you need investment. You need big investments in big physical things, ports and shipping, shipping container ships, that transocean container ships, and things that cost a lot of money, that are risky. They take a long time to build. They last a long time. If their profitability depends on long-term factors that are unpredictable, so you don't know for sure if they're going to be, they're risky. So you don't know if they're going to be profitable. How do you know there's not going to be another recession right after you build a big container ship? And so and there we live we've lived in this era, this neoliberal era, when investment in big physical things there's been a whole series of sort of mechanisms that corporations and financial markets have put in place to limit those investments, to make it harder, to make corporations more cautious about making those investments. And that, I think, is a big issue. It's going to be a big issue in the long term. So that is a sort of an aspect of like the kind of neoliberal modus operandi of the corporate sector now. That's definitely feeding into inflation. But on the basic question of what to do now, I would have to agree, with the Larry Summers of the world, in that it's not going to be that there's no sort of immediate solution. Yeah. Barring price controls, which is something that we can talk about, but in terms of like the antitrust stuff, breaking up corporations, making them more behave more competitively, that's not really a solution in the short term.
Yeah. So let's talk about what the Fed is doing, because obviously they just had their March meeting. They've decided to raise interest rates. And I believe Jerome Powell made some comment to the effect that he felt like wages were growing too quickly. So the Fed has now raised interest rates a quarter point. What is this going to mean for the economy and basically for the average American worker?
The pace of interest rate increases is certainly a lot faster than what people were expecting just a few months ago, but that's to be expected since inflation has been accelerating more. On the other hand, it's not the kind of pace of interest rate hikes that on its own is what you would expect to provoke a recession. I mean, I say that in other words, they're being somewhat cautious. But at the same time, because of the sort of unpredictability of financial markets and how financial markets are going to react to that and react to the events in the world, it certainly makes it more fragile. So there's more of a possibility that this is going to puncture the expansion and cause a recession. I don't think that they want to do that. There's certainly times in the past when many times in the past, when the Fed has deliberately provoked a recession, more or less, in order to deal with inflation. I don't think they want to do that in this case. You mentioned the wage issue. So up until about 6 months ago, about the late summer or fall, I would have said that inflation really doesn't have anything to do with wages, because wages were not growing especially fast relative to productivity, and most of the inflation was being caused by these supply chain issues, and inflation was concentrated within relatively narrow sectors of the economy.
Right.
Right around the late summer, early fall, there was a real breakout in wages. So there was the labor market had sort of got to a tipping point where employers felt like they really were forced to bid up wages in broad sectors of the labor market in order to find workers willing to work for them. And the context for this is that this is hard for people to wrap their minds around, because people think of the labor market right now as being very hot. It's like a tight labor market. It's good for workers. A lot of leverage. Workers have a lot of bargaining power, and that's certainly true as far as it goes. At the same time, though, the number of people with jobs today is actually lower than it was 3 years ago. So there's actually less employment now, but it's also a tighter labor market. And the reason for that, the explanation for that, is that there are millions of people who were in the labor market, who either had a job or were looking for a job 3-4 years ago, who are not in the labor market anymore. And that is the result of COVID. And then the question is, are they going to come back into the labor market? That's a whole issue that is a big part of the deliberations that the Fed is making, is the calculations that they're making. But the fact, the sort of on the ground fact, is that there is in fact a lot of upward wage pressure. Wages are rising faster than productivity, and that at this point is one of the main contributors to the inflationary surge right now. It's not the only one, and it's not maybe even still not the majority of the contribution, but it's there. It's a real pressure, and so that is something that I think that is the nub of the issue that I think the left. It gives the left something to think about, because there you really do have a situation where workers have a lot more leverage now than they did than they do in most times in the labor market, but that is contributing significantly to inflation. And then the question is, what do you do about it? What do you think about it? There's some people on the left who say, inflation is bad. It's never good for workers, because prices go up and there's all kinds of craziness that happens with speculation, and the housing market becomes more difficult. And my view is that on the one hand, you have to be honest and recognize that the tight labor market and the strong position workers are in are indeed contributing to inflation now, and that's like a central issue in the inflation debate. On the other hand, I don't think that there is any argument from a left point of view for wanting anything but for this to continue. I mean, because you've been seeing, and you can see the reporting by our excellent labor reporter, Alex Press and Jacobin, story after story, giving a picture of workers really gaining in self-confidence and willingness and ability to organize. That we haven't seen for a while. It's not a strike wave. We haven't seen, we haven't had like a complete transformation of working class consciousness, but there's something happening. And that's because, or in part because, we're living in times where the labor market has auspicious, material circumstances for that kind of shift. And I think that it can only help for that to go on. I don't see a lot of danger, and from inflation in itself. You have to recognize that inflation is never enjoyable, and that tight labor markets are contributing to it now. But in the end, I think the benefits that come from the strength that working people are getting from their position in the labor market outweighs whatever the costs or the nuisances of inflation. That's my take.
Yeah. So let's actually then end on this note of like what the left response could or should be to inflation, right? Because you had sort of hinted a little bit a while ago about price controls, which again is a very sort of thorny and weird subject. Maybe just end by talking a little bit about what that would entail and like whether that's bad or good.
Price controls are, of course, an age-old response to inflation, going all the way back to long before there was, economics as any kind of a social science. And there is the good and the bad of them. There have been price controls that have been smarter and less smart. In terms of what we think of as, traditional heavy-handed, government setting a price for this and that kind of price control. The most comprehensive recent example of that was World War II. But there was also, as recently as the 70s, the Nixon administration, in a kind of a tricky, devious way, they implemented wage and price controls to deal with inflation. Price controls can work in certain circumstances. Some kinds of inflation can be broken. There's a kind of a self-propelling dynamic that inflation takes on in situations like in the 70s, where you have a wage price spiral. I said before that wage growth is contributing to inflation right now, but we don't have a wage price spiral. And that's the difference between those two, is maybe something for another time. But in those situations, like in the 70s and during wars, when that kind of a dynamic happens, price controls can be like a circuit breaker. So you have a wage price spiral, but you put like a spoke in the wheel of that process by setting, by making it impossible for companies to raise prices except for according to a certain schedule. And that can be effective. In World War II, John Kenneth Galbraith was a famous gadfly economist in the post-war era, but during World War II, he was the head of the price control office, the Office of Price Administration. He was, a New Dealer, and he wrote a book after the war called The Theory of Price Controls. And he showed that price controls in World War II were very effective. Nobody wants to go back to the conditions of World War II, rationing and all the rest of it. But price controls can work in that sense. I think that there are probably, in this situation, certain very selective kinds of price controls that would make sense, that have to do with, preventing price gouging by corporations in very non-competitive sectors where there's no possibility of real competition. But I don't think that even if that happens, I think that could be a net positive. I think it could prevent, bad actors from doing bad things, but I don't think it's going to really solve the inflation problem. It doesn't make it not worth doing, but it's not going to solve the inflation problem.
All right. Well, on that note, Seth Ackerman, again, is Jacobin's executive editor. And Seth, what is the name of your newsletter?
Informer.
Informer. All right. Check it out on Substack. Seth, thanks so much for your time.
Thank you, Jen, as always.
If you like this video from The Jacobin Show, please hit like and subscribe and share with your friends. Thanks.